Good day, Market Chameleons, and everyone joining for the first time. Thanks for coming by and checking out our live Market Chameleon webinar series. Before we get started, let's take a look at the shared disclaimer. Please be aware that neither Market Chameleon, Dimitri, or myself are registered investment advisors or broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. This webinar, as all our webinars and shows, are for informational purposes only concerning Market Chameleon tools and products. One last look at the disclaimer, and let's welcome Dimitri Pargamonic to the stage. We'll be talking about screening for call spreads using valuation benchmarks. How you doing, D?
Good morning, Will. How are you?
Let me share your screen. There's the Market Chameleon landing page.
And yep, good morning, everyone. We're gonna look at some call spreads today and discuss some valuation benchmarks to help kind of screen and narrow down potential call spreads based on market prices versus those benchmarks. And first, let's navigate to our call spread screeners. So up top, you see screeners on the main menu. Then we're going to go to the right-hand side, click on Bull Call Spreads. This will take us to our screener. And you could see this screener. We have our filters above with tabs and data elements before. And we do have different tables with data and analytics. And we'll start from our summary page. And when we look at call spreads, especially screening, you have different symbols to screen, such as NVIDIA, Apple, and so forth. But within those symbols, there are lots of different potential combinations when you do a call spread, because you're buying a call on one strike, selling a call on a higher. In this situation, it's a bull call spread. So buying a call on one strike, selling a call on a higher strike within the same expiration. But there are different strikes of combinations, and then there are different expirations as well that you can do a call spread in. So here, for example, in NVIDIA, you could see going from left to right. This is NVIDIA's stock price and market cap. These are all sorted by market cap. So you see a lot of different call spreads over here for NVIDIA. This is over here. I'm going to go to this section here, which defines the call spread. So you could see these are all November 21st. And it's buying the 225 strikes on the 230 strike. So that's one call spread. Here's buying the 220 strikes on the 225 strike. That's a different call spread with the different expirations. So you can see there are different combinations of strikes that you could do. And of course, that's some are going to be in the money, at the money, out of the money, and also the distance between the strikes could be different, right? So you could have over here, these are $5 call spreads, but here's a $2.50 call spread, the $2.50 to $5. So what I'm going to do is also, let's expand the expirations, and we're going to look at expirations. It's defaulted to the first nearest monthly, but let's look at expirations that expire within the next 30 days. So when we do that, it's going to bring back now different expirations that expire within the next 30 days and different combinations of strikes. So you see now I have November 21st. Here's a November 7th, October 24th. So many different expirations. This little E here tells us that this expiration will cover earnings. So you see how I'm hovering over it. November 19th, there'll be an earnings that, and November 19th comes before the November 21st expiration. So now that we have all these, there are 144,000 different items here, right, to screen through. These are all NVIDIA, but if you tab through, you'll see other ones. It's just sorted by highest market cap. And when we look at these call spreads, we see a market price. So the market price is when you're buying a call spread, in this case, a debit call spread, the market, it would be the displayed ask price or offer. So a spread has, you have a bid and an offer. So these are evaluating it based on the displayed ask price. So we could go to the market data here, and you can see here that this spread is 16 cents a bid, 18 cents offer. This one's 23 cents bid, 25 cents offer. So if we're looking at a debit call spread, buying it, we're looking at it initially as, well, what is the displayed ask price people are willing to sell it for? And let's evaluate that price, okay, the market price. So let's come back here. So you can see here, these are the ask prices. And the question may be, well, how are these prices compared to some benchmark? Are we on the high end and the low end? Because there's so many different combinations, just staring, looking at them. We need a little bit more information to help us quickly assess, is it priced high? Is it priced low? And define some benchmark that we're comparing it to. So think of it as you had a list of different rental properties, and there are different prices, different maybe neighborhoods, different, they could be different factors, like a 2-bedroom or 3-bedroom, 1-bedroom. So you have all these potential opportunities. You have a list of prices, and then you're trying to go through them and just see, like, well, are they right now all priced on the higher end? Are they on the lower end? Or some of them on the higher end, some on the lower end? Like, gives us a certain idea of what we're looking at, especially if you have a really big list. So for that, we try to create benchmarks to help us, right? And we're going to look at 2 benchmarks. This first one, theoretical value, is saying, well, if we look at this call spread and we look at our history of similar situations, right? If we look at our history of similar situations in NVIDIA, where the stock price, where the expirations have, so many days till these options expire. The strikes are similarly distance away, and the situation in this case is, there's an earnings. So we're going to have to look at earnings historically, how the earnings moves compared, and take that data, that historical data, the stock moves, and say if we took those stock moves and averaged them out, what in theory would this call spread be worth? All right, so that's what we're doing, is just using a historical moves as our initial benchmark. So you could see here, then we get these values, like $1.58, $1.88, $2.19. So now we could kind of compare, well, based on how NVIDIA moved historically, there's, in theory, this spread on average would be worth this compared to now. And on top of that, we look at an average move, could get skewed up, higher or lower. So we have this historical success rate or win rate. And this shows us the amount of our historical observations where the stock moved in a way that would have made this spread at this price profitable. Okay, so you could have had 9 times it didn't work out and 1 time it did, right? But the average worked out. So we could open this up and kind of take a look at this analysis. So you could see here, these are the historical earnings moves. If we compared historically how it did. So you could see here, some of them had, really big gains here. So that's why this average is higher. And 37.5% of the time, it did move by a big enough, percentage move to make this spread at 18 cents profitable. So that's looking at historical moves, right? These would be non-earnings, October 24th. So see the non-earnings moves here, and the earnings moves is with the E. And if we wanted just to show me up here the best ones by theoretical edge. So the theoretical edge is saying, okay, if we compare the market price to a theoretical value, let's say the average, based on the average value of those historical moves, we could just say, show me best by theoretical edge. We click on that, and then it will pick the best theoretical edge for each of these symbols in our table, right? So that right now it's doing that. And let me see if I may have to refresh my screen here. One second. Well, I think my screen here stalled.
No worries, Steve. Take your time.
Yeah. So let's go back to, let's try this now. Theoretical, best by theoretical edge. So then this is going through, and unless I have a bug on here. Okay, so then you see here, it looks for each symbol and returns us the best theoretical edge, the differences percentage-wise. This one's in NVIDIA, Apple, Microsoft, Google, just to kind of take a look to see which one stood out. Okay. So that's looking at a historical move, but there's no one right way or one way to create a valuation model, because a valuation model is it's a model, right? It's like we put in inputs and coming up with this theoretical value, right? And think of it as like, if you're valuing a business or you're valuing a piece of, like, say, a real estate rental property, well, you could value a property based on the average sales of similar properties, or you could value the property based on how much income it generates, rental income, or how much it would cost to build a similar, piece of land and build a new one from scratch. So there are different ways to value that, get these approximate valuations. We looked right now at the historical stock moves. We could also look at, well, historically, how did the option prices line up in a similar situation? So what were the implied volatilities of similar options, given similar circumstances? And if we took the average of those, so that here goes to historical IV theta. That's over here. Okay. And this here shows us historically what is the average value of this spread if we took, the implied volatilities, we took snapshots of the implied volatilities, where we saw simultaneously, these two different options versus each other, and we created that theta value. So now we have another perspective, right? Now we have a perspective of how the implied volatilities, or how the options, similar options, measured up to today's values. So you can see it's a little bit closer now, because it's not looking at stock moves, but basically the implied moves, the observed market values of those implied moves, implied volatilities. Implied volatilities. So over here, like for NVIDIA, for example, it's right now priced at 18 cents. This is out of the money call spread. So, the stock's 181. These are 225, 230. Well, if we looked at historically similar spreads, based on how far away it is out of the money with the earnings coming up, well, we see that the on the lowest end that we saw in our observations, so we have 16 observations here, right? Because it had to cover earnings, so we went back a couple years, so we have 16 observations. On the low end, this was priced at 12 cents. On the high end, 60 cents, based on those, if we applied those implied volatilities. The median, half of the observations below 33 cents, half were above 33, right? And the average of all of them were 35 cents. So we could see that 81, if we just took 18 cents, 81% of the historically priced similar call spreads would have been priced above, right? Above this value, 19% below. So we could see that right now, this spread is priced on the lower end of its historical range, or the lower end of its implied volatility historical range. Similarly, like if you were looking at implied volatility and getting a percentile ranking on the implied vol, here we're doing the same similar thing on the spread, the call spread itself. Okay, and we're showing converting it to values, so we could compare the dollar values versus each other. And of course, you could screen by this as well. We could go back up here, look at the, I think it's over here, IV base Theo, and just say, well, show me any positive IV base, which would say that right now, as you can see, the price has a positive Theo because it's priced below that historical range. So we have like so it's below two benchmarks basically over here, right? That's what we used. We used two benchmarks and said, well, show me, where the market price is below the benchmark using historical stock moves. Show me also, because I'm using both, where the market prices are below the historical average values using those implied volatilities unique to that stock. Okay, so I'm going to stop right there. I just wanted to show how to use those two parameters today.
Yeah, that was a great job, Dee. Thanks for bringing that webinar to the Chameleon community, as always, my friend. Today is Wednesday, so we'll have another webinar tomorrow and hopefully on Friday. Great job, my friend.
Thanks, everyone, for joining. Stay safe out there. Have a great trading day, and we hope to see you tomorrow.
Have a great day, Dee. Bye. Hey, everyone. Thanks for joining the Market Chameleon webinar series. Everyone, stay safe out there. And remember, if you're on the social platforms, thumbs up, always appreciate. I see Jim giving the thumbs up. Everyone, thumbs up are helpful in the algorithms, so please do your best to give them to us. If you're new to Market Chameleon and joining us for the first time, let me get it up there. It's somewhere in this space. I have so many tabs up. Mike, I need you by my side, helping me with the tabs. Let me see. I have to share screen. Click on that. Oh, there we go. All right. Just when you're on the webinar, the Market Chameleon landing page, there's start free trial buttons all over the place. We offer a 7-day free trial. That's a good way to start with the Market Chameleon. So again, thanks for joining. We'll see everyone hopefully tomorrow for the live show. If not, you can always check it out at the Market Chameleon YouTube channel. All the videos drop to the YouTube channel. So everyone have a great day. Stay safe trading out there, and we will see you tomorrow. Bye.